global economy is sliding into a new kind of war, one where trade deals and tariffs hit harder than bombs. We're diving into one of the most dangerous economic battles of our time. The United States isn't just confronting China and Russia, it's pulling Europe straight into the fight. Donald Trump has ordered America's allies to place 100% tariffs on goods from both China and India, two giants inside BRICS. He presents it as a way to cut off Russia's war financing, but the reality is far riskier. Such a move threatens to cripple the very economies Washington relies on. Europe is already fragile. Germany's economy is shrinking, energy costs remain high, and factories depend on cheap imports from Asia to survive. Yet Trump is pressuring them to sever those supply lines. Meanwhile, BRICS countries are adjusting with precision. China is flooding Europe with low-cost goods that hold down inflation, while India is refining Russian oil and reselling it at a profit. These moves strengthen their position while Washington's demands push allies into crisis. Goldman Sachs estimates that most tariff costs fall directly on American households. Abroad, U.S. companies are losing ground as Chinese and Indian competitors capture markets once dominated by American brands. This isn't a strategy that secures advantage. It's one that drains it. Stay with me, because in this video we'll break it all down. Trump's gamble, Europe's vulnerability, and the calculated moves that are giving BRICS more power by the day. If you want the analysis others won't show you, make sure to subscribe now. Let's get started. The United States is waking up to what many nations have already realized. Global power is shifting. China, India, Russia, and their partners are weaving tighter trade networks that function without American approval. They're building supply chains, financial systems, and entire economic frameworks designed to bypass Washington. Trump knows this trend weakens U.S. influence, and his response is to push Europe into line. He has demanded that the EU impose 100% tariffs on goods from China and India, citing their ongoing purchases of Russian oil. The message is clear. Washington wants to make cooperation with these two countries too costly to maintain. But Europe is in no position to follow through without crippling itself. Its industries depend heavily on Asian trade. These aren't optional imports. They are the foundation of production. From raw materials and advanced electronics to chemicals, batteries, solar panels, and machinery, China and India provide the essentials that keep European factories running. If Brussels bowed to Trump and slapped those tariffs into place, the result would be devastating. Supply chains would fracture, shortages would spread, and production costs would surge. Energy and technology sectors, already under strain, would be hit the hardest. The price Europe would pay, both economically and politically, would be enormous. The numbers make Europe's dilemma impossible to ignore. In 2024, trade in goods between the EU and China reached about 732 billion euros. Out of that, Europe imported roughly 517 billion euros worth of Chinese products, while exports back to China totaled just 213 billion euros. The imbalance speaks for itself. European industry runs on Chinese inputs. From precision machinery and advanced electronics to green technology components and raw materials, the flow of goods from China is what keeps many factories operating. India may not match China's trade volume, but its role is becoming just as critical. It is now one of Europe's fastest-growing partners. Pharmaceuticals, specialty chemicals, industrial machinery, and a broad range of manufactured goods flow from India into European markets. On top of that, India's own trade reliance on both Europe and China has been deepening. According to UNCTAD, India's dependence on these two partners increased in the first quarter of 2024. For Europe, these aren't connections that can be cut with the stroke of a pen. Severing trade with China and India would mean disrupting entire sectors of the economy. It would ripple through supply chains, push up costs, and leave industries scrambling for alternatives that simply don't exist at scale. In short, Europe would be punishing itself far more than its Asian partners. Trump has already forced Europe into one painful sacrifice: abandoning cheap Russian gas and oil. For decades, those supplies were the backbone of Europe's energy security. But after Russia's invasion of Ukraine, U.S. pressure and sanctions pushed European governments to slash imports from Moscow. The consequences were immediate. Energy bills shot up, industries closed, and inflation surged across the continent. Now Trump is demanding another blow, this time aimed at China and India. He wants Europe to impose massive tariffs, even though the cost would fall squarely on its own shoulders. The imbalance in transatlantic trade makes this even harder to swallow. For years, the US has placed high tariffs on European goods, while expecting Europe to keep its own markets relatively open. When European companies try to export to China, they face hurdles like subsidies for local competitors or restricted access. But with the United States, Brussels is pressured to accept American exports with minimal barriers, while Washington keeps raising duties on European cars, chemicals, and other products. At the same time, the EU's deficit with China keeps widening. In 2024, it reached about 305.8 billion euros, with imports far outpacing exports. Officials in Brussels quietly admit that any drastic move against Beijing could provoke retaliation. Tariffs on European cars, restrictions on agriculture, or curbs on machinery exports. The fear of Chinese countermeasures weighs just as heavily as US pressure. For Europe, the choice is brutal. Damage vital partnerships with China and India, or face backlash from Washington. Either path carries heavy costs, and Trump's push for 100% tariffs only tightens the squeeze. If Brussels agrees, industries will face higher costs, supply chains will unravel, inflation will spike, and unemployment could surge. What Washington frames as strategy, Europe would live as economic self-destruction. To see how risky this is for Europe, look at Germany. In the second quarter of 2025, the German economy shrank by 0.3%. At first glance, that number seems small, but for a country long considered Europe's growth engine, it's a serious warning sign. Germany's most important exports, cars and auto parts, are now facing 20% US tariffs, cutting directly into its most valuable industry. On top of that, energy costs remain painfully high. Europe has locked itself into long-term contracts worth $750 billion for American LNG and oil, paying premium prices that make its factories less competitive. The options for relief are limited. Wages cannot fall much further, inflation is still too high, and electricity prices refuse to ease. What keeps German factories running today are low-cost imports from China and India. Those raw materials and intermediate goods are the lifeline that allows German manufacturers to sell products at prices global buyers can still accept. Without that flow, the system would buckle. Meanwhile, BRICS countries are not just surviving, they are thriving. In the first quarter of 2025, China's trade surplus with the EU reached $90 billion. If current trends continue, it could top $300 billion by the end of the year. Beijing has positioned itself as Europe's supplier of deflation. By exporting cheaper goods, it lowers costs for European businesses and households, while at the same time keeping its own inflation under control. That's not chance, it's careful planning. India has also turned sanctions into profit. By purchasing discounted Russian crude, refining it, and reselling it, New Delhi has built a business model out of Western restrictions. Europe, desperate for affordable energy, buys those refined products and avoids directly breaching sanctions. The result is that India gains revenue, influence, and leverage. While Europe struggles under rising costs and Washington's pressure, BRICS members are adapting quickly. They are finding ways to make themselves indispensable in global trade, turning every Western restriction into a new opportunity. Europe and the United States, meanwhile, remain tangled in policies that often work against their own economic interests. Step back for a moment and ask, who is really carrying the burden of Trump's tariffs? The answer isn't China. Research from Goldman Sachs shows that about 70% of tariff costs fall directly on American consumers. Importers absorb another 15%, while foreign exporters, such as Chinese companies, shoulder only the remaining 15%. In practical terms, every $10 added by tariffs means $7 come out of the pockets of American families at the checkout counter. For small businesses, the picture is even bleaker. The U.S. Chamber of Commerce estimates they will take a $200 billion hit from tariffs. Many of these firms operate on razor-thin margins. They can't raise prices without losing customers, so they absorb the costs themselves. Surveys reveal the gap clearly. Over 30% of US companies report higher costs from tariffs, yet only 13 to 15% have been able to raise prices. The rest are stuck watching profits evaporate, fighting just to stay alive. Trump sells this trade war as a shield for American industries. But the numbers tell a different story. Instead of gaining strength, the private sector is being hollowed out. Consumers face higher bills. Businesses are losing competitiveness, and jobs are quietly slipping away. Meanwhile, America's rivals are not slowing down. China keeps exporting, India keeps refining and selling energy, and Russia continues moving oil to buyers who are more than willing to sidestep Washington. What was meant to weaken opponents is instead draining America's own economic base. Slowly but steadily. The damage doesn't stop at American households or small businesses. Major US corporations that depend on global markets are running into serious trouble, especially in China. Only 41% of American companies there say they feel optimistic about the next 5 years, compared to a clear majority just a few years ago. The decline is sharp. Roughly 68% of US firms report that Trump's tariffs are hurting them directly, and more than half see no reason to expand investment in the country. When American firms retreat, competitors move in. Chinese companies are already filling the space US brands once dominated. Take Starbucks. Once unrivaled in China, it is now losing ground to Luckin Coffee, a local chain expanding aggressively with lower prices and deeper ties to local consumer culture. Entire industries can be reshaped in just a few years when American companies are forced onto the sidelines. The pushback isn't limited to China. Across the BRICS world, nationalism is driving calls to turn away from US products. In India, boycotts are gaining traction. In the Middle East, American brands are being quietly phased out. Even allies are showing frustration. In Canada, travel to the United States fell by 33% year-on-year, costing billions in lost revenue for American tourism and retail. At home, the danger is even clearer. Consumer spending is the lifeblood of the US economy, yet families are being squeezed harder each month. Businesses are cutting back, job growth is slowing, and every new round of tariffs accelerates the strain. Trump insists his measures protect America, but the outcome says otherwise. China is gaining market share, India is profiting from sanctions, Russia is still selling oil, and Europe is being pushed to the edge of crisis. The fallout for Europe could be catastrophic if it follows Washington's demand to impose 100% tariffs on China and India. Automakers would be hit first. Volkswagen, BMW, Mercedes-Benz, and their subsidiaries rely on China not only as a sales market, but also as a manufacturing hub. Volkswagen's CEO has already admitted that US tariffs this year cost the company several billion euros. If Europe now cuts off cheap Chinese parts and loses access to Chinese buyers, the industry would suffer from both ends: higher costs at home and shrinking revenues abroad. Luxury brands like Audi and Porsche would be especially vulnerable. Technology and machinery firms would also be exposed. ASML, Europe's crown jewel in semiconductor lithography, earns more than a third of its revenue in China. German chipmaker Infineon has similar exposure. Any rupture would slash margins, stall production, and slow investment. Beijing's retaliation would only make matters worse, with Chinese competitors ready to seize the abandoned market share. Even agriculture is at risk. China has already tested European pork producers with anti-dumping cases, and a trade war would drive exporters in Spain and Denmark into steep losses. Combine that with Europe's higher energy costs, locked in after cutting Russian oil and gas, and the pressure becomes unbearable. Europe is already paying heavily for American policies. Tariffs from Washington are biting into profits, and now Brussels is being asked to sacrifice its most important partners in Asia as well. For European industries, this doesn't look like partnership. It feels like economic sabotage. And the question hanging over Europe is simple. How long can it keep absorbing these blows before breaking away from Washington altogether? Let me know your thoughts in the comments. And if you want to keep following how these trade wars are reshaping the global balance of power, make sure you're subscribed. See you in the next one.